Hey, this is Macro Atlas. Retail phone was a trap. How we'll be preparing for Bitcoin next leg down, and how the stock market is capped to the upside. So things that will be considered in this video are, of course, oil prices, government bond yields, the 10-year specifically, core inflation, since that's a better indicator of the economy, does not include energy in its calculation. We're going to be discussing employment rate, and of course, the Fed's balance sheet, why we're seeing an uptick in net liquidity, where is it coming from, and is it quantitative easing, or is it just some stress plumbing in the economy? So the first thing is, of course, Bitcoin, technically wise, we have reached the top side of the channel, and we have gotten rejected and started going down. So I actually did open a short at the top here, and I did buy oil in that zone. And the course event-wise, what happened is at that level here, Iran has opened, of course, the Strait of Hormuz. But then just less than 24 hours later, they closed it again, and we peaked up there and we went down. This wasn't surprising, as their ceasefires are unreliable, their talks are not going anywhere, and geopolitically, I think it's just going to get worse from here. This why this seems like a retail trap, especially if you understand that we have only touched on just so slightly in the natural absorbed levels of oil, elevated prices, but we are spending more time in the pressure building zone and the macro stress zone. So if oil remains in the suppressed levels that they are in right now, that could turn markets a little bit more bullish, right? But if oil just reverses back to its elevated levels prior to the announcement of the closure of Strait of Hormuz, which opening of which they closed again, then that seems like an event-driven move and not structurally wise. And event-driven moves will revert back to the mean and match to the fundamental view of the market, right? So a lot of people have talked about this price fracture, right? Snippet fracture from the stock market, right? So I know we're going to move to the stock market a little bit, but it's important to understand how cross assets do behave. So a lot of financial funds and institutions and professional traders, they understand price behavior through price behavior of a specific targeted asset through price behavior of other assets and what they're doing. It's called the cross asset relationship, right? And studying the stock market will really help us understand how Bitcoin could behave, and even Bitcoin could help you understand how the stock market could behave as well, right? We've talked about this price snippet months ago, right? Like months ago. And now it's resurfacing back on X and YouTube and social media. So we're going to be discussing it again, just to explain it and make sure those who don't know it know it. Now, people usually just show you that part, from like the 1995 and to the 2000 and tell you, yeah, we're having a dot-com bubble type of crash. Well, that might be relevant. I don't think both environments are similar, and I don't believe that they're both in the same technological pathway, right? So in AI, if you get an AI boom, but if AI works, then you might maybe just get some stagnation until the technology is proven, and then everyone is going to be like, yo, this is going to improve GDP. We're going to see some economic boom from there. People's lives will improve, and that might just kick off another bull market. While now we might follow that price snippet, that price structure that the dot-com rally did have before. It doesn't mean we always stick with it. But if it's following it, then it's definitely something to look at and seeing if it diverges or not. So if you take it, I find it best if you take it from the 1982 up way till here. So if you do just that, and you align it with the price from here. So I already did that, but that's how if you want to study on your own. Now, the first thing we can observe is even though we divert a lot from current prices, right? You can see here and here, this was above, this was below, here as well, and there, and here was the most major one where there was but you would say that COVID-19 was an anomaly that had diverted price from moving from its normal course, but that anomaly, once it has been dealt with, price reverted back to the better than even before, right? To the price snippet. But it's important to understand that anomalies and black swan events can happen, which can trigger something off course, right? But right now, and why many people which have been watching this chart, expected this market rally, is because of this, basically, right? Previously, the stock market has rallied off that point, and the previous dump also corresponded to the dump of the dot-com bubble. And according to this chart, to me, this rally wasn't really surprising. It was very expected, just because I look a lot at that price snippet, and I was kind of prepared for it. That's why I closed some of the, I adjusted my portfolio and trading accordingly. So, if we follow the following price snippet, then we will stay at the current prices for the next year to 2 years. At the same level, we will just do nothing, basically, for the stock market. And while the stock market might do nothing, it doesn't mean that Bitcoin and other risk assets cannot fall down and do something. And history, we have enough history. If you compare the stock market and Bitcoin, then you would actually see that they do divert, and we will study that. While we might actually stagnate and maybe drop below a little bit, it doesn't mean we might follow that, right? We might get that type of crash, I believe, if things escalate geopolitically, or some black swan event, or really the AI bubble just bursts and it's really a bubble and there's no anything useful coming out of it for the next few years, and maybe a technology that will be very beneficial 5 years later. Sure, there's a lot of reasons, a lot of narratives that can work, but I just, it's not the base case, and we shouldn't assume the worst case scenario, right? We should just maybe keep our time horizon to the next year or 2 years, than just panic about what could happen 3 or 4 years later, because anything can happen to make the price action of the stock market divert from that price snippet, and just like we have seen during COVID. So we have diverted away from that structure for around 2 years, okay? But we just came back. So things take time to play out. Things need time, right? And things might divert away for a long time, and if they divert and nothing comes back to the natural course, then you might actually get an upside, and that snippet will be thrown out the window, right? But for now, we're following it, and it's amazingly accurate. Now, what does that mean for Bitcoin? If we stagnate, let's assume that we stagnate, and the stock market could actually go around 12% above its current highs, and that's fine. That's fine. That's normal. Fine. That doesn't mean we're in a bull market. That's normal. Bitcoin did something similar, as you can see. This cycle, we made a high, and then we made another high at around 10 to 20% higher. That might be foreshadowing what the stock market could do, because, well, I believe that Bitcoin is a risk asset, so it's more, it gets signals more early, and it shows them more abruptly as well, because it's a more risky asset and a new asset, right? So we can feel things a little bit earlier. That's why crypto always peaks much earlier, sometimes a little bit earlier, but sometimes much earlier than the stock market. It happened here, and it happened here as well. Okay, so crypto can feel sense of things a little bit earlier. Now let's look at the theory that, okay, if the stock market stagnates and does nothing, what does it mean for crypto? Is there something back in history that tells us that crypto could actually, specifically Bitcoin, can actually decline during that time span of period? Sure. You don't need to look further than 2 cycles away, right? The 2013 market crash for Bitcoin. We had topped right here, okay, on December of 2013. But the stock market didn't stop going higher. It didn't. And that corresponds to a crash that actually was relevant for the dot-com era run-up cycle, okay? If the stock market actually followed the previous dot-com bubble era run-up, then we would have been in line, just peaked a few months earlier. But no, the stock market continued up. And continued up for a long time. For around just 560 days, a little bit less than 2 years, right? But that didn't stop crypto, specifically Bitcoin, from going down. While the market rallied up around 16%. All right? So if we highlight the peak, which is right here, okay, let's do that. We can see that the stock market went up while Bitcoin went down. And then the stock market stagnated while crypto stagnated, Bitcoin, sorry, stagnated for a while. And then Bitcoin rallied up before the stock market rallied up. So risk asset felt there was something bullish. I believe it was, increasing liquidity and stuff like that, that made crypto rally faster and earlier than the stock market. Okay? So conclusion here is even if the stock market, the S&P, rallies up or stagnates, crypto can feel a hit. But there's one caveat to this theory, that Bitcoin was a very early asset and it was not mature, right? So that theory can be tested in the current cycle. But we should always remember that things may have changed. ETFs are launched, and there's more than just retail early traders and early adopters in the market that made Bitcoin a very risky investment, and maybe we're more in line with the stock market. But it's current data, and here's just a second example. The stock market stagnated and made new highs for around a little bit less than a year, and if you want to extend that to here, then it's around more than a year, while crypto actually saw a drawdown to the downside right here. Here we just stagnated, and we even made new highs, and we formed new lows and new highs again. But Bitcoin has definitely had a 90% crash. Just to keep in mind that this has worked 2 cycles before. That's in terms of the price snippet and how the cross-asset relationship works there. Second, there's no reason for Bitcoin to go higher. I mean, at least in my macro view, right? In my opinion, oil prices are still elevated, and the closure of Strait of Hormuz means maybe oil prices on the opening of the stock market might actually rally up to the pressure building and the micro stress zone again, because tensions are still high. That's one. Two, yields, the 10-year yields are still elevated, all right? And they maybe have formed a low here, but I think we might go up to the top side and retest the highs of that channel. By the least, breaking out would mean a crisis. We don't want it to break out. But it looks like this is just a short-term relief, and maybe we test the range highs. Okay? Inflation is on the rise. So we did have an uptick, and that's core inflation. So core inflation should feel the energy shock not even so soon now. It should be in the next print. I don't think oil prices have moved enough. Maybe it moved to headline inflation, sure, obviously, but core inflation, it does take a little bit of time. Headline inflation just skyrocketed. Bad sign, very bad sign. Employment rate just hit the bottom of its channel and might stick till might go up again and form another high. Right now, we are trending in an upward channel and in an increasing trajectory to the upside. That doesn't sound bullish to me. The stock market, we have talked about it. And now we move to liquidity. Recently, there has been an uptick in the Fed's balance sheet. But do not mistake that for quantitative easing. Okay, net liquidity did rise up, and that means there have been some kind of easing in the market, but it's not easing. Don't confuse it. The Fed names it plumbing. You know, there was some credit market, private credit stress in the banking industry, and they're just kind of feeding liquidity in there mostly. So yeah, net liquidity did rise up, but they're still in the low range uh, of the whole period for the past 5 years. We're still in the low ranges, right? Where it's drying up. And if you notice here, the reverse repos, okay, the reverse repo just hit zero. So the Fed was just injecting some 40 billions here, and that was mostly from the reverse repo reserves that they had. Well, that's hit zero. Think of reverse repos as the ninja of liquidity in the market, you know, like they're just a cushion. So like if somebody falls down, you can put a cushion and boom, hopefully they get some damage, but not so much. That's the cushion, the cushion of the Fed, what they can use without framing it as quantitative easing or increasing liquidity in the market. It's easy to just make some plumbings, you know, you get just some like, you know, patches and patch the wall. That's the reverse repo. Well, they ran out of patches. So now any form of macro stress or banking stress will have to be done through other means like increasing their balance sheet or reducing their liabilities to increase the net liquidity in the market, which is more of a stress zone on the Fed themselves too. So you can see that both not only macro stress, the Fed is also stressed. That's also worrying. The reverse repo is at zero. Just a few days ago, I think interest rate probabilities that we will have a reduction have, you know, rate cuts in June of 2027 was more likely. Now it reversed back to September. So rate cut expectation is worsening again. We just switched fast, opening of Strait of Hormuz, closing of Strait of Hormuz, and the market reverted back. And the current Bitcoin rally looks like it was kind of a short squeeze, right? There was a lot of liquidations that happened here, and guess what? Liquidations. I mean, now people are going long, so in consolidation periods, price likes to follow liquidity. So I would not be surprised that we actually start heading down because liquidity is building up. People are going long, they're bullish, but I think this is just a short-term relief rally, and it could be a trap for retail. So please be careful. Oh yeah, one more thing about the stock market. That outlines the period of distribution. So that's what that says. Okay, if the market does that, that's a distribution. What happens in distribution phases? Well, retail buys stocks, and by the way, if you hear any company saying we're increasing dividends, please don't buy their stock. Usually that means, oh, retail, can you buy the stock so we can offload our stock on you because we are expecting a downtrend to the downside, right? That happens for hundreds of years in America. You can read a lot of books on it, especially Jesse Livermore. He used to do it himself, right? So just be careful. He used to use the dividend in bear market as a signal that the company might be going under, and he would short actually the company there. That's just one of his strategies. Yeah, so Strait of Hormuz, we're back to 2 ships passing by. Only 6 have been passed in the last 24 hours. Here it says 60 usually daily average, but some reports say 120 or something like that. So that's way less, 5 to 10% of the actual strait functioning capacity. One more thing we will discuss, which is, I think, is pretty important. If you see, there's a pattern that works out with liquidity here. Every time open interest collapses, you see a rally to the upside, especially in the previous raising wedge pattern that we broke to the next leg down for Bitcoin. It rallies up and then we crash down. We've seen something similar right here now. Open interest has collapsed just immediately. At the bottom, we have liquidated all the shorts. We went up and we made a new high, just like there. And Is that something here to worry about? Because the same thing happened. Open interest collapses, we rally, then we crash. Open interest collapses, we rally. Is the crash coming? We don't know. It also happened here. We go down, open interest collapses, builds up open interest, market peaks, market collapse. I hope you have learned something from this video. Let me know if you like it. So please, if you did like it, drop a like. Tell me what you think about some of the ideas here. And do you see any contradicting views? Do you have any of your opinions? Comment below. Let's discuss it. I'll see you in the next one.